Good afternoon. Today we're asking, is there a difference between markup and margin? And if so, what is that difference? We'll be working through an example of break-even analysis as well today. I've joined by Graham Potts, who's a chartered accountant and our managing director at our accounting firm, Wessex Commercial. With an eye for numbers and having years of hands-on experience running in corporate and in his own businesses, Graham is great at understanding the issues business owners face running their businesses and coming up with real life experience of how to solve these problems. Graham, I know today you want to talk about whether there's a difference between markup and margin or what the difference is, but to many people, those will appear to be the same.
Thanks, Linda, and welcome everybody. Yes, there is a difference in one respect, but to confuse you, they're the same in another.
Okay.
So it's not surprising that people get confused and think they're the same. But don't worry, the point of today is I will explain more and show you how markup and margin are calculated. So it's clear when they aren't the same.
So this is confusing. Can they be the same and different at the same time? I think you need to explain.
Okay, yeah, it is very confusing. Now, markup is often used by sales operational people, and it's adding a profit percentage to your expected cost of a product or service to give you a profit in money terms. Mm-hmm. So, for example, let's just say you're producing widgets. You would put the cost in there and you bring up to a cost, not with the overhead, just the cost. So the materials, mm-hmm. labor, transport, consumables, etc., until you get to a cost. Then they put a profit percentage that it might include an overhead percentage as well, but it's basically that's what they get to their markup. Mm-hmm. However, financial people look at the same profit, so the same profit in money terms, but the profit percentage is calculated differently, as they don't divide the profit by the cost. They calculate it by the profit divided by the sales or turnover figure. So they get a different percentage and they call it gross margin or gross profit percentage.
Okay. So you're saying that the profit is the same in money terms in both cases?
Yes, I am.
Okay. But there's a different percentage.
Exactly. The percentage is different. So the money's the same, but the percentage is different. And that's where the confusion is.
Okay. Well, I know a lot of people find percentages really confusing. I know I always have to really think them through carefully. Perhaps you can give, I know you're going to talk us through an example. We're going to bring up a graphic so that we can see that on screen. So let's go for it, Graham.
Okay, right. Hopefully everybody can see it. I can. So let's say you're buying and selling widgets. The accountant's friends, they always talk about widgets. So you buy a particular widget, and this applies to products, services, everything basically. But you buy something for £100. You then want to add 50% markup. Now, I'm trying to keep these percentages easier. You know, I'm a mathematician, so it's easier for me. But 50% on £100 is £50. So what you get a cost of £100, markup of £50 gives you a sales value of £150. So the markup is £50, but so is the gross profit percentage. Mm-hmm. But when accountants, bankers, other financial people, they see it in a different way. They see the money in the same way, but then they use a different percentage. They call it the gross margin or gross profit percentage. And they express the £50 as a percentage of sales. So that's 33.33%.
Okay. So we're all talking about the same £50, but tell us why the percentage is different.
Okay. Yeah, this confuses a lot of people, and I've been through this a lot of times with a lot of people. They are different because markup is percentage as expressed, as a percentage of cost, the direct cost, whilst gross margin, gross profit from financial people is expressed as a percentage of sales. So in the example, your cost is £100 and your sales are £150. So the markup percentage is 50 over 100, which is 50%. And your gross profit percentage from a financial point of view is 33%, which is the £50 divided by the 150. So it's over sales. So financial people talk the same money terms, but over sales. The operational type people markup is over the cost. And although, like I said, although they're the same, the percentage is different. So it leads to so much confusion.
So when financial people ask what profit a business is making, the business owner says 50%. The financial person thinks that the business is doing better than it actually is, because in fact they're only making a 33% gross profits.
Exactly. Okay. In the example, if a business says it's expecting 50% expected margin, because that's how they're thinking markup, then the financial people will expect a much higher profits percentage. And we'll get onto this later, but I'll just say that to get a 50% gross profit percentage, you would need to mark up by 100%. So you'd have to add £100 onto the cost of sales to give £200. We haven't got a graphic for this, so trust me. So 100 onto 100 is 200. And that profit, £100 divided by the sales figure of £200 is 50%.
Yeah. So, we're trying to improve communication here and help people understand, talk the same language. So how does a business owner explain profit to a financial person?
Well, I do think it works both ways. A business owner really needs to understand the difference between markup and margin from a percentage point of view. So they should explain they've marked up their percentage by so-and-so, so that they expect a lower gross profit percentage. But I really think it lies with financial people, because they should do the same, and they've had the training. So they should always ask the business owner, can you explain how you price? So how do you price? What markup do you use? Oh, you mark up 50%, so that would give you a gross profit margin or percentage of 33%. So I think it's, it works both ways, but it's really, I'd say, on the financial people. Otherwise, there's disappointment, because, I've seen it where they have marked up around 50%. Financial guys were expecting 50%. The actual margin was actually near enough spot on, around 33%. So basically, everything was as anticipated, but they spent so much time trying to work out why and delving in and thinking that something had gone wrong, or something had been, was there waste, was there, theft or whatever, when actually they were at the right sort of margins. They were just talking different languages. So I see it like the film Lost in Translation. They're talking so many different languages, and that's what happens. Accountants and operation people generally don't always understand each other. So I think it's from the accountants to actually slow down and explain and ask the right questions to make sure they come up with the right answer.
Definitely is, definitely. I wonder if you can give me an example, Graham, of how you've used markup and margin to help businesses.
Yes, there is one question I'm asked numerous times. What is my break-even sales value? What value of sales do I need to actually break even? I mean, this was really, sort of came up a hell of a lot more when we had COVID, because people were saying, how can I just get to break even? So, that is one thing that I think I'd like to go through in a minute.
Okay. So how do you work that out for business?
Okay. Right. First of all, you need to work out your overheads. That's the costs, your fixed costs that would carry on regardless if you were selling products or service, producing products or selling services, and it suddenly stopped. Now, I would stress that if that happened, you'd cut your losses and cut down. But I'm just saying, a moment stop, suddenly those sales, you're not getting any sales. Now, overheads include such things as premises, running costs, staff that are not involved with producing products and services, such as accounts staff, salesmen, admin staff. It also includes sales and marketing, admin costs, financial costs. That's what overheads include, whereas direct costs are your direct labor involved in making something or selling something, sort of producing something, materials, transport, etc. Once you've got your overheads, though, now look at your average gross margin percentage. That's not your average markup, your average gross margin percentage. Then you work out the break even by dividing the overhead by the gross margin percentage. I keep on stressing that's not markup, that's the gross margin percentage.
Can you give us an example with some numbers?
Okay, my favorite widgets, we're selling widgets and our overheads are, say, 500,000. With an anticipated gross margin of 33%, 33.33%, that's not markup, that's margin. I keep on stressing that. You divide the 500,000 overhead by the 33% gross profit margin, and you get a break even. That's 500,000 divided by 0.333. You'll find that comes to 1.5 million. Basically, it's treble the actual overhead costs. Now, so the business needs to make needs to turn over at least 1.5 million. And if you're selling your widgets in this example at £150, that's 1.5 million divided by 150, which is 10,000 widgets a year to break even. But a word of warning: a lot of small businesses, they take minimum salary and pay themselves dividends. So you need to put that into. So if you're taking dividends as part of a salary sacrifice, you should add these into the overhead calculation and a bit of corporation tax. So say the directors pay themselves a minimum of 12,500 roughly and take 80,000 dividends between them in this example. With corporation tax, you sort of gross it up. That comes to roughly about 100,000. So your overhead goes from 500 to 600,000. I know this is confusing. I'm an accountant. I deal with numbers all the time. Apologies. But that means your break even would be 600,000 divided by 0.333, which is 1.8 million.
Yeah. It's slightly artificial taking, when you've got directors getting such a small salary when actually they're dependent on those dividends coming through as well. So yeah, they have to.
It is, and I would just add that they forget that when they're looking at how profitable they are, they have to add that dividend that's part of their salary sacrifice plus a bit of tax into the actual the net profit figure to give them a more realistic, because that's what anybody would look at it from a financial perspective.
Yeah. And what else can that break-even calculation be used for?
Well, it can be used to work out when you're considering increasing your overhead, such as taking on a salesperson or admin staff, or maybe sort of new location. But it also applies equally if you're going to cut back. So say we're all talking about recession. If you need to cut back, what happens if, what's your break-even position if you, like for instance, like move premises to a smaller premises or cut some cost, maybe you take out if you basically make a couple of people redundant, and you have to get the real cost of that, the full cost. What does that affect your sales figure? So it can be used either way, but it's when you're changing something.
Yeah, and I'll pop the link on the screen for details of a previous live that we did, where we talked through that new salesperson example. But as you said, it could apply to increasing any other part of your overhead, or making some of those changes that you've talked about. Is there anything else that you want to add, Graham, on how and when to use markup and margin?
I think just say that markup is very, very good for pricing. It's the easiest thing to price, to use for pricing. But gross margin percentage is great for break-even analysis, looking at taking things on, bringing people on, contracting or whatever. So they both have their place in the business owner's toolkit. Yeah. Okay. So what do business owners need to do on the back of this information? Well, I'm always saying, and sorry, it's a broken record now. I'm always saying how vital it is that business owners understand their numbers, but also they understand financial language, which is very difficult. Now, if they don't, then they basically need to make sure someone else knows and understands, things like markup, gross margin, difference between direct and overhead costs. And you need a good count system like Xero. With the right support, you can get up-to-date numbers. So you get meaningful information, which you need because the business world is changing so fast now. Next, I'd say you need to analyze the true cost of your business decisions, which you can use these tools to make sure you make the right decisions. And that's whether, taking on a member of staff, changing a location, whatever. And using that break-even analysis that we explained earlier. I'd also ask, is there a smarter way? It's all about maximizing the use of your resources. Are they being maximized? Are they working efficiently for you? Are you sure that your people, premises, stock, cash systems are working to your advantage? And also, I'd also say creating efficiencies in automation, cutting out waste. You don't have to increase your costs, such as moving on. Can you move on slow moving stock, obsolete stock, which could bring in better stock, and actually you sell and move it on. I think you just need to be thinking, now, and I'm sure a lot of people listening to this will be thinking these sort of things, but think of smarter ways to do things. Because the world is changing. And for business owners, it is very, very lonely. It's uncertain. You don't know what's happening. There's so many changes happening all the time. So business owners need good, up-to-date management information and the right support to help them make the right decisions for them and their business.
Yeah. And we've been talking a lot about sort of building resilience as well as increasing profits, but it's so important that people are talking the right language and understand that the language that's being used when they're making those changes in their business.
So I would say that I've been in so many meetings with accountants and operational people, and they're talking, and I'm going, hang on a minute, you're talking different languages. And explain. And so actually, and then try. You've got to see it with anything in business. You've got to see it from the other person's point of view, whether it's a customer, member of staff. You've got to try and put yourself in their shoes and understand what they're trying to say, and not just saying, "Oh, that's the way it's done." You've got to try and empathize with them and put yourself in their shoes.
And it's tricky because there's an expectation, that being a business owner is probably one of those roles that you in because it's something you're good at and you love and you want to do, or you've got an opportunity to do and you want to make the most of it. And there isn't, people don't go into it with any formal training, and it's easy to get caught out by things like this. So it's so important that we get the language right. If you want to some help to do that, if you want to understand profits better in your business and build that resilience, we're very happy to set up a free, no obligation conversation with Graham. I'll pop the email address on the screen, chat with Graham at weststatescommercial.com, pop over an email and we will set up that conversation. Next time, we're back on the 10th of October with the question, think your business needs finance, then think again. So we'll look forward to seeing you at 12:30 p.m. on Monday, the 10th of October. So thanks everybody for joining us. Take care.
Thank you.